Most Americans buy a starter home with a strict 5-year exit plan. They view it as a quick stepping stone, a temporary launchpad for wealth. But a hidden group of buyers is choosing a radically different path. They never leave. They stay inside that modest starter home for 20 full years. Society calls this a compromise. The data reveals it is a financial superpower. By the end of this video, you will see the exact $1 million mistake. Let us meet Marcus. In the year 2006, he purchased a basic 2-bedroom house. His friends laughed. They wanted grand McMansions instantly. The pressure to upgrade your lifestyle is a powerful psychological trap. Economists call it lifestyle creep. It destroys more middle-class wealth than any market crash. Marcus resisted the urge to follow his peers. His monthly mortgage payment stayed completely locked at $1,200. It was safe. It was incredibly predictable. Meanwhile, his friend David bought a massive luxury property. David wanted to look successful. His initial monthly payment was $4,000. A heavy burden. Look at what happens behind the scenes during year 5. Marcus received a massive promotion at work. His income soared. His housing costs remained identical. What did Marcus do with that extra surplus cash flow? He did not buy a luxury boat. He funneled it directly into basic index funds. This is our first major pattern interrupt. Most financial gurus tell you to buy real estate for maximum leverage. But they ignore the brutal cost of phantom expenses. Phantom expenses are the silent wealth killers. Property taxes, homeowners insurance, roof repairs, landscaping fees. They all scale up drastically with a larger house size. David spent his weekends fixing a massive 5-bedroom property. His property taxes doubled in less than 7 years. He was trapped on a financial treadmill. Marcus spent his weekends enjoying his life. His small roof cost a fraction to maintain. His property tax increases were minimal. He stayed completely nimble. By year 10, a fascinating psychological shift occurred inside the starter home. Marcus and his family stopped tying their self-worth to their physical zip code. They realized something profound. A house is a consumption item disguised as an investment. The real wealth was growing silently inside their brokerage account. But what about space? The family grew. 2 children arrived. The small 2-bedroom house started to feel incredibly crowded. The ultimate temptation had arrived. Every real estate agent in America will tell you to move up. They use emotional phrases. They say your family deserves a bigger backyard. Marcus almost broke. He toured a beautiful 4-bedroom home. The price tag was staggering. The transaction fees alone would cost $30,000 down the drain. Transaction fees are completely forgotten when upgrading. Agent commissions, moving expenses, title insurance, loan origination fees. It is pure friction that builds zero equity. Instead of moving, Marcus made a bold counter-move. He decided to optimize his existing space. He invested $10,000 into clever built-in storage. He added a beautiful outdoor patio. He turned the backyard into a compact sanctuary. This pivot saved him hundreds of thousands of dollars in interest. Let us look at David during this exact same period. David felt house poor. Every single dollar went to his giant mortgage. He had zero emergency fund. Then the unexpected happened. A major economic downturn struck. David lost his corporate job. The massive fixed monthly mortgage immediately became a ticking time bomb. Because his expenses were so high, David was forced to sell his dream home in a panic. He lost all his accumulated equity to commissions. Marcus watched this disaster happen from across town. His low mortgage allowed him to survive the downturn with absolute ease. He even bought discounted stocks. This brings us to year 15. Something magical happens to compounding interest around this milestone. The gap between Marcus and David became an unbridgeable chasm. Inflation was now working directly for Marcus. His $1,200 mortgage felt incredibly cheap compared to rising market rents everywhere else in the country. Think about your own current housing situation right now. Are you paying for space you do not actually use? Let that question linger for a second. Marcus was utilizing every square inch of his starter property. The kitchen was a hub of activity. The bedrooms were fully optimized. No wasted space. People often argue that a larger home appreciates more in absolute dollars. That sounds logical on the surface. But the math is fundamentally flawed. If a $300,000 home doubles, you gain $300,000. If a $1 million home doubles, you gain $700,000. Right. Let us dig deeper. You must factor in the cost of capital. The interest paid on that larger loan over 15 years completely eats away the extra capital gains. Marcus saved over $200,000 in pure interest alone by avoiding the upgrade trap. That money was aggressively compounding in the background. His stock portfolio was now doing the heavy lifting. It grew larger than the value of his house. He achieved true financial independence before age 50. Now imagine the freedom of looking at your bank account and realizing your investments pay for your entire lifestyle. That is the power of staying small. David eventually rented a modest apartment after his foreclosure. He had to start his entire financial journey from absolute scratch in his late 40s. The stark contrast between these two paths is entirely driven by housing leverage. One used leverage safely. The other let leverage crush his future. Let us move into year 18 inside the starter home. The children are getting ready for college. The cost of education is skyrocketing across America. While other parents were taking out massive Parent Plus loans, Marcus simply wrote a check for tuition. His cash flow was completely unburdened. The freedom to absorb massive life expenses without stress is the ultimate luxury. It beats any marble countertop or triple-car garage ever built. This is another critical pattern interrupt. We are trained to believe our home is our primary asset. But your primary asset is your freedom. When you lock yourself into a massive monthly payment, you sell your freedom to your employer. You cannot take risks. You cannot pivot careers. Marcus took massive career risks because his overhead was so low. He joined an early-stage startup during year 12. It paid off handsomely. If he had a $4,000 mortgage, he could never have taken that risk. He would have stayed stuck in a dead-end corporate job forever. This is the hidden cost of the big house. The opportunities you are forced to decline because your monthly survival cost is simply too high. Let us examine the neighborhood dynamics over those 20 years. The starter home neighborhood slowly gentrified. Restaurants opened. Public transit improved significantly. The value of Marcus's humble home rose steadily anyway. He did not need a mansion to benefit from long-term American real estate appreciation trends. He captured the location value without paying the massive square footage premium. That is a masterclass in financial efficiency. Pure economic optimization. We are approaching the exact midway point of this 20-year experiment. The results are undeniable. The math completely destroys standard societal advice. Let us do our mid-video check-in. Which strategy would you choose for your own family? The small permanent home or the rolling upgrade path? Tell me below. Now let us enter the final stretch. Year 20 arrived. A monumental day. Marcus walked to his mailbox and opened a very specific letter. The letter was from his bank. It contained two beautiful words stamped in red ink. Mortgage. Satisfied. The house was now fully his. His housing costs dropped to zero, except for basic property taxes and insurance. His monthly fixed expenses plummeted to a few $100s. Think about that feeling. Absolute shelter security. No bank could ever take his home away. He owned the dirt. He owned the roof. His peers were still grinding away in high-stress jobs to pay off their second or third upgraded mortgages. They were locked in until age 65. Marcus stood in his kitchen. The same kitchen where his kids took their first steps. The walls held 20 years of rich, unbroken family memories. There is a hidden emotional benefit to staying put. Stability. Children who grow up in one permanent home often report a deeper sense of security. They do not have to constantly switch school districts. They do not lose their childhood friends. They have deep roots in a single community. But let us return directly to the cold hard math. Because that is where the starter home strategy becomes completely undeniable. Let us calculate Marcus's total net worth after 20 years of staying inside that simple 2-bedroom property. Prepare to be shocked. The starter home itself appreciated from $300,000 to $650,000. A solid, predictable gain. But remember his index fund investments. The surplus cash he saved every month by avoiding a giant mortgage was compounding at 8% annually. That investment account grew to a staggering $1.4 million. Entirely built from the savings of a modest lifestyle. His total net worth crossed $2 million. He was a multimillionaire next door. Driving a normal car. Living in a normal house. Now let us look at his friend David, who followed the traditional upgrade path for 20 years. His situation was completely different. David had owned 3 different houses over that 2-decade span. He constantly traded up every time his salary increased even slightly. He paid over $100,000 in real estate agent commissions alone. He restarted his 30-year mortgage clock 3 separate times. By year 20, David lived in a gorgeous $700,000 home. But his mortgage balance was still $500,000. His home equity was only $200,000. His retirement account was completely empty because his cash flow was always choked. David had the appearance of massive wealth, but his actual net worth was a fraction of Marcus's. He was trapped in golden handcuffs. This is the core financial illusion of the American middle class. We confuse large liabilities with actual wealth. They are polar opposites. A house is a liability until the day it pays you income. It demands constant cash. It eats your labor every single month. By keeping his liability small, Marcus maximized his active assets. He allowed his money to work for him instead of working for his money. Let us look at another massive benefit. Stress reduction. Medical studies show that housing cost burden is a leading cause of chronic anxiety. Marcus never had a single sleepless night regarding his housing payment. If an emergency occurred, he could cover his mortgage with a part-time job. David lived in a permanent state of high alert. One bad quarter at work meant total financial ruin. His health suffered significantly. The peace of mind that comes from living below your means is completely unquantifiable. It changes how you interact with your family. You become a patient parent, a supportive spouse, a creative thinker. You are no longer running for pure survival. But what happens when the 20 years are up? The kids have finally left the nest for college. The starter home is suddenly quiet. This is the ultimate plot twist of the starter home strategy. Marcus is now sitting on a fully paid asset and a massive liquid portfolio. He can now buy his dream luxury home with cash if he wants to. He does not need a mortgage at all. The tables have turned. He can downsize even further. Move to a beautiful beach condo. Travel the world continuously. His choices are absolutely unlimited. David is forced to keep working his stressful corporate job for another 15 years minimum just to clear his remaining housing debt. He can never retire early. He missed the prime compounding years of his life because he was chasing a status symbol. Let us address the common counterargument about pride. People say they would feel embarrassed living in a starter home for 2 decades. Ego is the single greatest expense in personal finance. The desire to impress people you do not even like is a terrible deal. Marcus conquered his ego in year 1. The financial security he gained was a far better status symbol than a long driveway. Think about the freedom of telling your boss you are leaving because you simply want to try something new. No fear. Absolute leverage. That is what the starter home gives you. It is not just sticks and bricks. It is a financial fortress that protects your family. Let us analyze the final wealth transfer step. Because Marcus has a massive portfolio, he can help his children buy their own starter homes. He creates a multi-generational wealth cycle. The legacy of the small house extends down through his family tree for generations to come. David will likely need his children to support him during his old age because his retirement accounts are dangerously underfunded. The trajectory of these two families diverged completely based on a single real estate choice made 20 years prior. One decision shifted everything. You do not need to win the lottery to become a multimillionaire in America. You just need to resist the temptation to constantly upgrade. The starter home is the ultimate hidden wealth hack. It sits right in front of us, disguised as a modest compromise. Next time you look at a small older property, do not see it as a stepping stone. See it as a potential financial launchpad. The numbers do not lie. True wealth is built by maximizing the gap between what you earn and what you choose to spend. Marcus chose freedom over square footage. 20 years later, he has both. His experiment was an absolute, undeniable triumph. You can make the exact same choice starting today. Analyze your housing footprint. Look at the data with completely fresh eyes. Would you willingly stay in a starter home for 20 years to lock in a multi-million-dollar retirement? Share your honest thoughts in the comments below. And consider subscribing for more financial deep dives.